What's going on, everybody? It's the Blockchain Raccoon keeping you updated with the latest cryptocurrency news and analysis. Today, we're going to take a look at an article about the US debt ceiling crisis, a catalyst for crypto's ultimate decoupling. Many in and beyond the crypto industry believe that the political standoff around the debt ceiling increases makes digital assets more attractive in the long run. The United States federal government's default on its debt has been averted, at least for now. On October 7th, the Senate voted to increase the debt limit by $480 billion, a sum needed for the world's biggest borrower to keep paying off its obligations until early December. The deal secured a temporary resolution for a weeks-long partisan standoff that had investors both within and far beyond the U.S. unsettled. The once unimaginable prospect of a U.S. default seemed more conceivable than ever before. As the system-wide uncertainty pinked ahead of the vote, the cryptocurrency market has been doing just fine, led by Bitcoin's biggest bull run in months. This has spurred customary narratives of crypto decoupling from more traditional asset classes and of Bitcoin as a safe haven in times of looming financial disasters. So what are the possible effects of the debt limit crisis on the role of digital assets in the global financial system? Now, an increasing credit card limit. So the US government, thanks to controlling the printing press for the world's reserve currency, has a unique power to set up its own debt limit. Congress first imposed a cap on the aggregate national debt in 1939, increasing this limit on more than 100 occasions since then. While the debt ceiling increase is normally not a partisan issue, things were different this time around. Embittered by Democrats' ambitious social and climate spending agenda, the Senate Republicans took a principled stand, refusing to back their opponents' attempts to address the impending deadline for either raising the debt limit or defaulting on federal debt. The lack of Republican support for increasing the debt limit, which requires 60 votes to pass the Senate rather than the simple majority that Democrats already wield, could be considered a symbolic move. Raising the amount of money that the Treasury could borrow does not authorize new spending in and of itself, but rather is meant to allow it to cover existing obligations. Partisan politics aside, some critics believe that the federal debt policy that relies on constantly increasing the borrowing cap is not great for the wallets of regular Americans. Chris Klein, co-founder and chief operating officer of cryptocurrency retirement investment provider Bitcoin IRA, noted to Cointelegraph, "The government has given itself the ability to increase credit card limit every year for the last 100 years on average, and that has ramifications for the middle class. Middle-class Americans are feeling the biggest pinch in their wallets from inflation and rising costs, all spawned from a monetary policy that is expanding the USD balance sheet." End quote. The temporary path of a solution that the Senate has agreed on only staves off the debt ceiling issue until early December, effectively perpetuating the macroeconomic uncertainty. One prominent argument is that this uncertainty can play into Bitcoin's hands in the coming weeks. Ariana Kuslava, head of the corporate payment solutions at cryptocurrency exchange CEXIO, believes this uncertainty could potentially continue to be a driver of the Bitcoin rally. At the same time, Kuklava noted that the cryptocurrencies are starting to trade apart from the legacy markets, which could lead them to being less malleable to microeconomic dynamics that considerably affect the more traditional asset classes. Kay Kanmane, managing director at online trading platform Spectra AI, believes that the impact of the debt limit suspension on financial markets in general, including digital assets, is likely to be favorable, as it would mean more liquidity in the system, which tends to flow to financial assets first. Kamini further remarked, higher debt does not erode the value of the dollar over time and further strengthens the narrative, however misguided it may be, that crypto is a safe haven asset. Still, the degree to which cryptocurrencies have decoupled from other assets like stocks is still a matter of debate. Eric Bleeker, an analyst at investment advice company The Motley Fool, commented to Cointelegraph, as a kind of currency that relies on predetermined math instead of politically brinkmanship, you'd figure Bitcoin would benefit from events like debt ceiling standoffs. While most Bitcoin fans point to this being an asset with a limited supply that should gain in value while the US prints more debt, the reality is that it's been mostly correlated to the value of other risky assets in the short-term sell-offs. So, one example that Bleeker invoked was Bitcoin briefly dropping more than 50% in March 2020 at the beginning of the pandemic. He also added that things may play out differently in the long run, as events like the debt ceiling crisis degrade trust in the dollar and make alternatives like Bitcoin more attractive. There are some long-term benefits. While the industry participants and analysts differ on the short-term effects of the U.S. federal debt limit uncertainty on the cryptocurrency market, most of them sound remarkably constant when discussing how it can influence the market in the long run. Two concurrent trends that are often mentioned are the erosion of trust in the dollar and institutions backing it, and the rising demand for crypto. Huan Xo, CEO of digital asset trading platform Amplify, expects that raising the debt ceiling will steadily apply more pressure on the Bitcoin, causing prices to steadily rise over time. Marie Tayabov, frick, I cannot read these names, man. Oh my god, I'm sorry. Chief Marketing Officer of cryptocurrency exchange Gate.io thinks that crypto quality as the market hedge will shine through. Tayabov added that the crypto market has already outgrown stocks and gold since the pandemic began, adding if there is indeed a financial crisis due to the government defaulting, then crypto will be a safe haven in the long term, as it's already proven to be. Daniel Goldman, CEO and co-founder of financial service provider Unbanked, called the entire dance around the debt limit increase absolutely ridiculous, as it makes the United States credit score hostage of the partisan politics. We welcome more people into crypto, as our elected officials continue to play chicken with the full faith and credit of the US dollar and US government's commitment to its own prior spending decisions. Ron Levy, CEO of blockchain education and training firm The Crypto Company, notes the contrast between the two financial systems that the debt ceiling crisis makes conspicuous. Levy commented to Cointelegraph that this might have been the time when the crypto industry finally decouples from traditional finance. On the traditional side, he noted that we have an inevitable continued money printing, growing inflation, and economic uncertainty. On the crypto side, we have industry that is growing and continues to grow exponentially. So it is very likely impossible to tell if the ultimate decoupling is attainable at all, let alone when it can be achieved. Yet the debt ceiling crisis goes a long way toward highlighting the difference between how traditional and digital money is governed. And this comparison is not particularly favorable to fiat currencies. I don't know, folks. We're gonna have to see how this whole game plays out. But you gotta understand, there is a plan. The chess pieces are being moved around the board. Every single day, everything is falling into place. Just gotta open our eyes and follow the money. Don't get consumed and get off guard by all these stupid little look here, look over there things. Keep your eyes on the prize, folks. I'm gonna wrap this up by stating the obvious that I am not a financial advisor. I'm a little raccoon making YouTube videos about the cryptocurrencies. Thanks for tuning in.